Good evening, everyone. We are the Group 1. Today, we will tackle about the controlling. These are the members of Group 1. The next reporter is Mr. Carion. He will tackle about the definition, importance, and sentence in control process in controlling.
So for the next topic is the definition of controlling, its importance and steps. So controlling something is equal to monitor something. Also referred to as change management, control management sets standards, measure performance, and take corrective action. So basically yung controlling is yung nagmo-monitor ng mga changes sa management sa isang project and yung mga nagka-countermeasure para sa mga risk and problem na dadating sa isang project. Importance. Control management is a process as it helps your business detect errors and put the right corrections in place and keep your project management on track. So, importance ng controlling is sila yung nagpa-manage ng project on track para maging smooth lang yung daloy nung project na ginagawa nyo. And syempre sila rin yung nag-countermeasure, nagko-correct ng mga errors, nag-check kung may mga problema ba sa system na ginagamit nyo. So what are the steps? Set performance standards, measure performance, compare actual performance against performance standards, analyze deviation, and take corrective actions. Set performance standards is yung magsaset sila ng proper na value para sa gagamitin na system kung aakma ba doon yung value na performance nung device na gagamitin nila. Tapos yung sa measure performance naman is may measure nila yung performance nung kunwari nung controller na para sa pumps, i-measure nila yon kung yung performance ba nun is akma sa standard na quality ng isang standard quality ng isang product. So next is compare actual performance against performance standards. Yung dito naman is pagko-compare yung actual performance dun sa performance standards, which is yung sa performance standards is yun yung kailangan na ma-meet ng actual performance. Kumbaga pag below the minimum ng performance standards yung ginawa nung actual performance is hindi siya pwede or hindi siya compatible na gamitin para doon. Analyze deviation is yung magse-set ng mga limits para doon sa performance na gagamitin, and take corrective actions is pag nakapag-set na ng mga limits is dito na pwede gawin ng paraan pa kung paano ma-resolve yung isang problema sa project or system nila.
Types of control: feed, forward, concurrent, feedback. Feed forward controls, sometimes called preliminary or preventive controls, attempt to identify and prevent deviations in the standards before they occur. Feed forward controls focus on human, material, and financial resources within the organization. These controls are evident in the selection and hiring of new employees. For example, organizations attempt to improve the likelihood that employees will perform up to standards by identifying the necessary job skills by using tests and other screening devices to hire people with those skills. Concurrent controls monitor ongoing employee activity to ensure consistency with quality standards. These controls rely on performance standards, rules, and regulations for guiding employee tasks and behaviors. Their purpose to ensure that work activities produce the desired results. As an example, many manufacturing operations include devices that measure whether the item being produced meet quality standards. Employees monitor the measurements. If they see that standards are not being met in some area, they make a correction themselves or let a manager know that a problem is occurring. Feedback controls involve reviewing information to determine whether performance meets established standards. For example, suppose that an organization establishes a goal of increasing its profit by 12% next year. To ensure that this goal is reached, the organization must monitor its profit on a monthly basis. After 3 months, if profit is increased by 3%, management might assume that plans are going according to schedule.
8.3 Organizational Control System. Organizational control system allows executive to track how well the organization is performing, identifying areas of concern and then take the action to address the concerns. The three basic types of control system are available to executives: output control, behavioral control, and plan control. Sa output control, sila yung mga nagko-control dun sa mga natapos na or yung mga gagawin na outputs sa isang kumpanya. Sa behavioral control naman, sila yung mga naghihiwalay o tumitingin ng mga bad behavior ng mga empleyado. Sa plan control naman is sila naman yung nagbabantay or sila yung mga supervisor sa bawat organization sa isang kumpanya.
So good evening everyone, I'm Glacial Francilario. In 8.4 Strategic Control System, there are 3 components. These are the financial analysis, financial ratio analysis, and identifying control problems. In financial analysis, it also referred to as financial statement analysis or accounting analysis or analysis of finance. The financial analysis also refers to an assessment of the viability, stability, and profitability of a business, sub-business, or a project. So in financial ratio analysis, financial ratios are mathematical comparisons of financial statement accounts or categories. This relationship between the financial statement accounts help the investors, creditors, and internal company management to understand how well a business is performing and areas of needing improvement. So ratios allows us to compare companies across industries, big and small, to identify their strengths and weaknesses. There are 4 parts of financial ratio: the liquidity, efficiency, financial leverage, and profitability. So, in liquidity ratios, these ratios assess the ability of a company to meet its current obligations. In current ratio, this shows the extent to which current assets of the company can cover its current liabilities. So, to get the current ratio, the formula is the current ratio equals to current assets divided by the current liabilities. So, the second one is the acid test ratio. This is a measure of the firm's ability to pay off short-term obligations with the use of current assets and without relying on the sale of investors. So the formula of acid test ratio is acid test ratio equals to current assets minus inventories over the current liabilities. Next is the efficiency ratios. These ratios show how effectively certain assets or liabilities are being used in the production of goods and services. Among the more common efficiency ratios are the inventory turnover ratio and the fixed asset turnover. So first is the inventory turnover ratio. This ratio measures the number of times an inventory is turned over or sold each year. So the formula for this is the inventory turnover ratio equals the cost of goods sold over the inventory. So the second one is the fixed asset turnover. So this ratio is used to measure utilization of company's investment in its fixed assets, such as its plant and equipment. So the formula for this is the fixed asset turnover equals the net sales over the net fixed assets. Financial leverage ratios. This is a group of ratios designed to assess the balance of financing obtained through debt and equity of sources. Some of the more important leverage ratios are the debt to total assets ratio and the times interest earned. So first is the debt to total assets ratio. So this ratio shows how much of the firm's assets are financed by debt. So the formula for this is the debt to total assets ratio is equal to total debt over the total assets. So next is the times interest earned ratio. So this ratio measures the number of times that earnings before interest and taxes cover or exceed the company's interest expense. The formula for this is the time interest earned equals to profit before and plus the interest ratio expense divided by the interest expense. Lastly is the profitability ratios. These ratios measure how much operating income or net income in a company is able to generate in relations to its assets, owner's equity, and sales. So first is the profit margin ratio. This ratio compares the net profit to the level of sales. The formula in getting this is profit margin ratio equals to net profit divided by the net sales. So the second one is return on assets ratio. So this ratio shows how much income the company produces for every profit invented in assets. To get this, the formula is return on assets ratio equals to net income divided by the assets. So for the third one, for profitability ratio, is the return on equity ratio. This ratio measures the returns on the owner's investment. So for formula for this is the return on equity ratio equals to net income divided by the equity. So for identifying the control problems, there are three components: executive reality check, comprehensive internal audit, and the general checklist of symptoms of inadequate control.
General checklist of symptoms of inadequate control. An unexplained decline in revenues and profits. The two main reasons for a decline in operating profit are fairly easy to pinpoint. You either have a decrease in sales or an increase in expenses. Understanding the different reasons this occur can take more digging before you can stem the tide of profit erosion. A degradation of service. A degradation of service attack is a type of denial of service attack geared toward disrupting the service, speed and response time of a network or website. Employee dissatisfaction. Job dissatisfaction is when an employee does not feel content in their job. This can be due to various professional and personal reasons such as lack of advancement, poor management, limited work-life balance, and more. Cash shortages caused by bloated inventories or delinquent accounts receivable.
That's all, everyone. Thank you for listening.